What is unfolding in silver right now is not a normal fluctuation in price, and it is not another short-term speculative wave. The structure underneath the market is shifting in a way that only becomes visible when you step away from daily charts and look directly at physical flows, vault data, and delivery mechanics. Across multiple institutional reporting systems, signals have begun aligning in a pattern that historically appears when paper exposure starts drifting away from physical reality. Within a very short time window, several key indicators moved in the same direction. London vault inventories reported by the LBMA fell to their lowest level since transparent reporting began. In Asia, Shanghai silver pricing widened sharply against London benchmarks, with premiums reaching levels that have remained elevated far longer than normal arbitrage cycles would allow. In the United States, deliverable silver inside Comex storage dropped below thresholds last seen during previous liquidity stress environments. At the same time, forward pricing in London began showing repeated episodes of backwardation, a condition that rarely persists unless immediate physical demand is outpacing available supply. When these signals appear together, the important point is not any single metric in isolation. Each one can be explained away on its own. The significance comes from their synchronization, because it indicates that pressure is not local but systemic. Start with London, which remains the core clearing hub for institutional silver outside of Asia. According to recent LBMA data, total vaulted silver holdings now sit around 892 million ounces. That number still appears large at first glance, but the trend behind it tells a very different story. At the beginning of 2022, total holdings were closer to 1.24 billion ounces. That means over a relatively short multi-year window, the system has lost roughly 348 million ounces of inventory, a decline of nearly 28%. This reduction is not just statistical noise. London operates on a pooled allocation structure where most participants do not hold individually segregated bars. Instead, they hold claims against a shared pool of metals stored within custodial vaults. This system functions efficiently only when total claims remain comfortably covered by physical supply and when redemption pressure remains low. The problem begins to emerge when that balance shifts, and what is now visible in the data is a gradual but persistent reduction in available liquidity inside that pool. A shrinking inventory base means fewer ounces are available to satisfy unallocated claims, especially during periods where physical delivery demand increases even slightly. A deeper layer of stress becomes visible when separating allocated from unallocated holdings. Allocated silver, meaning metal that has been specifically assigned to identifiable owners and removed from general availability, now represents approximately 43% of total London vault inventory. Just a few years earlier, that figure was closer to 31%. This change is subtle in isolation, but structurally significant in context. It means that nearly half of all silver stored in London is no longer part of the freely available liquidity pool. When combined with a declining total inventory base, the remaining unallocated portion becomes increasingly sensitive to demand shifts. What matters most here is not just the reduction in total supply, but the change in behavior of institutional holders. When more participants move toward allocated metal, it signals a declining willingness to rely on pooled claims. That shift does not require panic to matter. Even gradual repositioning can create tightening conditions when the underlying system depends on continuous recycling of unallocated inventory. Another important signal comes from pricing behavior inside the allocation structure itself. The premium paid for allocated silver over unallocated exposure has been rising steadily. A few years ago, that premium averaged around 1.2%. More recently, it has moved closer to 2.7%. This increase represents more than just a pricing adjustment. It reflects a growing willingness among institutional participants to pay for certainty rather than exposure. In commodity markets, rising premiums for physical segregation often appear when confidence in pooled liquidity begins to weaken, even if only marginally. At the same time, total inventory levels are not stabilizing. They continue to trend lower over extended periods. This creates a compounding effect where the buffer that normally absorbs fluctuations in demand is shrinking, while the preference for secured allocation is increasing. That combination reduces the flexibility of the entire system. To understand why this matters, it is important to recognize how London functions in global silver pricing. The system does not rely on constant physical movement of bars. Instead, it depends on the assumption that claims can be settled or rolled without requiring mass physical redemption. As long as that assumption holds, the system can support a large volume of notional exposure relative to physical stock. But when inventory declines and allocation increases at the same time, that assumption becomes more fragile. The system becomes less about abundance and more about availability under stress conditions. This is where early pricing signals begin to appear. One of the first is the widening gap between different forms of exposure to silver. When investors are willing to pay more for guaranteed physical allocation rather than unallocated claims, it signals that the perceived risk of non-delivery, while still low in absolute terms, is no longer negligible in relative terms. Another emerging sign is the interaction between London and external demand centers. As inventories decline, even modest shifts in global demand can have outsized effects on available liquidity. Metal that leaves the system is not always quickly replaced, especially when competing demand sources are simultaneously absorbing supply. This creates a subtle but important dynamic where physical silver begins to move more directionally across regions rather than cycling freely through arbitrage mechanisms. Over time, this reduces the efficiency of price equalization between markets. What makes the current situation more sensitive is that this is occurring while other global hubs are also showing stress signals. That means London is not operating in isolation. Instead, it is part of a broader network where liquidity constraints are appearing in multiple locations at once. When multiple hubs begin showing similar stress patterns, it increases the probability that the issue is not regional but structural. And in commodity systems, structural constraints tend to express themselves first through spreads, premiums, and delivery behavior before they fully appear in headline price movement. At this stage, the most important takeaway is that the foundation supporting smooth paper-to-physical conversion is becoming thinner. That does not mean a collapse is imminent or guaranteed. It means the margin for absorption is narrowing. Historically, periods like this do not resolve quietly when they eventually shift. They either stabilize through sustained pricing adjustments that incentivize new supply and reduce demand, or they transition into sharper repricing phases where physical constraints begin to directly influence market pricing rather than remaining in the background. The current London data is best understood as an early structural warning rather than a completed event. It shows a system that is still functioning, but under increasing dependency on conditions that are gradually tightening rather than easing. What happens next depends on whether these liquidity trends stabilize or continue to accelerate. If they stabilize, the system may remain in a prolonged state of elevated premiums and reduced flexibility. If they continue, the probability increases that pricing will begin to reflect physical constraints more aggressively across global silver markets. Beyond London, the next layer of confirmation comes from Asia, where physical demand conditions are reflected more directly in spot pricing behavior. Shanghai has become one of the clearest reference points for real-time physical silver pressure because its pricing often reflects actual industrial consumption rather than purely financial positioning. What is currently visible there is a sustained divergence between Shanghai and London pricing that has persisted far longer than typical arbitrage cycles. Recent data shows Shanghai silver trading at a premium of approximately $2.83 per ounce over London spot pricing. While premiums between regions are not unusual, what makes this situation notable is both the magnitude and the duration. In normal conditions, Shanghai premiums tend to fluctuate within a relatively narrow range, typically reflecting import costs, logistics, and short-term demand changes. Historically, that range has remained roughly between 20 cents and 80 cents per ounce. The current level is several times higher than that historical range, and more importantly, it has remained elevated for an extended period rather than correcting quickly. That persistence is the key signal. In efficient global commodity markets, sustained premiums create arbitrage incentives that should normally force rapid adjustment through increased imports until the gap closes. However, the fact that the premium has not normalized suggests that physical flow dynamics are not functioning in a fully frictionless way. Either supply is constrained, demand is consistently absorbing incoming metal, or both conditions are occurring simultaneously. Trade data supports the second interpretation. China's silver imports have increased significantly, with recent quarterly volumes reaching approximately 1,847 tons, representing a strong year-over-year increase. At the same time, exports have declined sharply, falling to roughly 287 tons over the same period. This combination indicates that silver is flowing into China at a faster rate, while flowing out at a reduced rate. In simple structural terms, China is acting as a net absorber of global silver supply. When this happens consistently over time, it reduces the amount of freely circulating metal available in other regions, particularly in Western vault systems that rely on continuous liquidity recycling. The important detail is that even with rising imports, the Shanghai premium has not collapsed. This suggests that incoming supply is being absorbed by demand almost as quickly as it arrives. That type of behavior typically appears in markets where consumption demand is structurally strong rather than temporarily elevated. At the same time, this flow imbalance creates pressure on global inventory distribution. When one region consistently draws in physical metal without equivalent outbound flows, other regions must supply that demand gap from existing stockpiles. Over time, this reduces the buffer available in those supplying regions. This is where the connection between Shanghai pricing and Western inventories becomes critical. Arbitrage is supposed to stabilize these differences. When premiums rise in one region, traders import metal from lower-priced regions until equilibrium is restored. But for that mechanism to function smoothly, there must be sufficient available inventory and frictionless logistics. What the current data suggests is that while arbitrage is still operating, it is not fully capable of restoring balance quickly enough to eliminate persistent premiums. That means the system is operating under conditions of constrained elasticity, where price differences can persist longer than normal because physical adjustment is not instantaneous. Now shifting focus to the United States futures market, Comex provides another layer of structural insight. The key distinction here is between registered silver and eligible silver. Registered silver represents metal that is immediately available for delivery against futures contracts, while eligible silver is stored in approved vaults, but not currently committed for delivery. This distinction becomes critical when evaluating the actual deliverable liquidity in the system. Total Comex silver inventory is significantly larger when combining both categories, but only a small portion is classified as registered and therefore available to meet immediate delivery demand. Recent levels of registered silver have fallen to approximately 30.8 million ounces. When compared to total Comex inventory of roughly 336 million ounces, this means only a small fraction is actually available for delivery at any given time. The rest remains in eligible storage and cannot be automatically used to satisfy futures obligations. At the same time, open interest in Comex silver futures represents a notional exposure that is many times larger than the registered inventory base. With each contract representing 5,000 ounces and total open interest near 94,000 contracts, the theoretical exposure reaches hundreds of millions of ounces. This creates a structural imbalance between paper claims and immediately deliverable metal. Under normal conditions, this does not cause disruption because most contracts are rolled or closed before delivery occurs. However, the system becomes more sensitive when even a small percentage of contracts begin standing for physical settlement. Historical precedent shows that during stress periods such as March 2020, the share of contracts demanding delivery can rise sharply, placing significant strain on available registered inventories. At that time, registered stocks were higher than they are today, yet the system still experienced near-critical delivery pressure conditions that required adjustments to prevent disruption. The current environment is more constrained because registered inventories have declined significantly from previous peaks. This reduces the buffer available to absorb unexpected increases in delivery demand. At the same time, London lease rates have moved higher, indicating that borrowing physical silver has become more expensive. When lease rates rise, it typically reflects tighter availability of physical metal in lending markets. In conjunction with rising premiums and declining inventories, this reinforces the broader signal of tightening physical liquidity. Another important indicator is backwardation, where spot prices trade above near-term futures prices. This condition has reappeared in London for multiple consecutive sessions. In commodity markets, backwardation is often interpreted as a sign that immediate physical demand is stronger than future availability, or that market participants are placing higher value on near-term delivery certainty. When backwardation occurs alongside rising lease rates and declining inventories, it suggests that physical tightness is not isolated to one segment of the market, but is affecting multiple layers of pricing structure simultaneously. Looking at historical comparisons, similar configurations of signals appeared in both 2015 and 2020 prior to significant repricing events. In both cases, the sequence involved tightening inventories, rising regional premiums, and stress in futures delivery systems. While the triggers differed, the structural outcome followed a similar pattern of rapid price adjustment once physical constraints became binding. The key difference in the current environment is scale and duration. Inventory declines have been larger, premiums have remained elevated for longer periods, and delivery-related indicators have stayed under pressure for extended durations compared to previous cycles. This does not imply an immediate breakdown, but it does suggest that the system is operating closer to its physical limits than it has in prior stress episodes. When multiple indicators remain elevated simultaneously over long periods, it increases the probability that the market is transitioning from a flexible liquidity regime into a more constrained pricing regime. At this stage, the critical takeaway is that neither Shanghai nor Comex nor London is operating independently anymore. Each system is reflecting different aspects of the same underlying condition, tightening physical availability relative to paper exposure. The next phase of analysis depends on whether these pressures stabilize or continue to intensify, and whether arbitrage mechanisms can still efficiently transfer physical metal between regions fast enough to prevent deeper structural divergence across global silver pricing systems. As the pressures across London, Shanghai, and Comex continue to interact, the final layer of the system becomes visible through how institutions are positioning in physically backed vehicles and how delivery behavior responds when all three pricing centers begin reflecting the same underlying constraint. This is where short-term market interpretation starts to lose importance, and structural liquidity dynamics become the dominant force shaping price behavior. One of the most important components in this final layer is the flow behavior into physically backed silver exchange-traded funds. These vehicles hold large quantities of real silver stored in vaults and act as a bridge between paper investment demand and physical metal ownership. When inflows into these funds increase during periods of already tight physical conditions, they do not simply represent passive investment activity. They translate into direct demand for physical bars that must be sourced from the same wholesale system supplying industrial users and exchange inventories. At the same time, when premiums in physical markets remain elevated, authorized participants responsible for creating ETF shares face higher costs in sourcing metal. This creates a feedback loop where institutional demand and physical scarcity begin reinforcing each other rather than balancing each other. Under normal conditions, this mechanism is self-correcting because arbitrage ensures that ETF pricing remains closely aligned with underlying metal availability. However, when liquidity tightens across multiple regions simultaneously, that arbitrage becomes more difficult to execute smoothly. The result is that ETF flows become not just a reflection of investor sentiment, but an active pressure point on physical supply chains. Sustained inflows during tight conditions can accelerate inventory drawdowns in wholesale markets, especially when combined with ongoing demand from industrial users and regional import flows such as those observed in Asia. This brings the system to a critical stage where scenario outcomes begin to diverge based on how physical constraints evolve. The first possible outcome is a rapid repricing phase. In this scenario, silver experiences a sharp upward adjustment in price over a relatively short period, driven not by speculation alone, but by the need to rebalance physical supply and demand. When prices rise quickly in this type of environment, two things typically happen at the same time. First, industrial demand begins to moderate as manufacturers delay discretionary consumption or seek substitution where possible. Second, higher prices incentivize additional supply from above-ground sources such as recycled silver from electronics, jewelry, and industrial scrap. This combination of demand reduction and supply increase helps relieve pressure on physical markets, allowing premiums to compress and lease rates to normalize. Historically, this type of adjustment has resolved previous silver stress episodes when price movement was sufficient to re-establish equilibrium. In those cases, the system did not fail. It simply repriced until incentives aligned with available supply. The probability of this outcome depends on whether current conditions are primarily driven by cyclical demand pressures or deeper structural inventory depletion. The second outcome is a prolonged consolidation under structural tension. In this scenario, silver does not experience a clean breakout or breakdown, but instead trades within a wide range characterized by recurring volatility spikes. Physical premiums remain elevated, but they do not escalate indefinitely. Instead, they oscillate within a higher band than historical norms. In this environment, inventories stabilize at lower levels rather than continuing to decline sharply. Comex registered stocks fluctuate within a constrained range as metal moves between categories depending on delivery demand and storage decisions. Lease rates remain elevated compared to historical averages but avoid extreme spikes. The system effectively adapts to a new equilibrium where physical silver consistently trades at a premium to paper pricing, and market participants adjust their behavior to this persistent structure. This outcome is significant because it represents a transition rather than a breakdown. It suggests that the market can continue functioning, but under permanently tighter liquidity conditions. Arbitrage still exists, but it becomes less efficient and more dependent on pricing incentives to move metal between regions. The third outcome is a systemic breakdown in the paper pricing mechanism relative to physical reality. This does not necessarily mean a collapse of the market, but rather a breakdown in the reliability of paper prices as a true reflection of available physical supply. In this scenario, one or more stress points exceed critical thresholds. This could include a situation where delivery demand on futures exchanges overwhelms registered inventories, or where confidence in unallocated bullion systems weakens to the point that participants aggressively shift toward allocated physical holdings. It could also be triggered by regulatory or logistical disruptions that limit the ability of metal to move between regions efficiently. When this type of breakdown occurs, price discovery shifts away from paper contracts and toward physical transaction markets. ETF inflows may surge as investors attempt to secure metal exposure, while futures markets experience increased delivery pressure. Lease rates can spike sharply as holders of physical silver demand significantly higher compensation to lend metal into a constrained system. In this type of environment, paper prices may continue to exist, but they lose their dominance in setting real-world transaction levels. Physical silver trades at its own premium, determined by availability rather than exchange pricing, and the gap between paper and physical markets can widen significantly. What makes this scenario particularly important is that its probability increases gradually as structural stress accumulates. It is not a binary switch, but a rising likelihood as inventories decline, premiums persist, and delivery ratios remain stretched over time. To evaluate which path the market is currently moving toward, a small set of indicators becomes critical. London Vault inventory trends remain a primary measure of system-wide liquidity. Continued declines indicate ongoing structural drawdown, while stabilization suggests temporary equilibrium. Shanghai premiums provide insight into regional physical demand pressure and whether arbitrage is still functioning effectively. Comex registered inventory levels remain a direct measure of delivery capacity within the future system. Lease rates in London provide real-time feedback on physical borrowing stress, while forward curve structure indicates whether near-term scarcity is being priced into futures contracts. ETF flow behavior adds a final layer by showing whether institutional demand is reinforcing or relieving physical pressure. When all of these indicators align in the same direction, the probability increases that the market is transitioning from a flexible liquidity regime into a constrained physical pricing regime. In such a regime, price no longer acts purely as a smooth balancing mechanism. Instead, it becomes a reactive output of physical availability constraints. The broader lesson from historical cycles is that these transitions often appear gradual at first and then accelerate rapidly once thresholds are crossed. In both 2015 and 2020, early signals of tightening were visible in inventories and premiums well before major price moves occurred. However, most of the adjustment happened in a compressed timeframe once physical scarcity became fully reflected in pricing. The current environment shares structural similarities with those periods, but it also shows differences in duration and persistence. Inventory reductions have been more extended, premiums have remained elevated for longer periods, and multiple indicators have stayed stressed simultaneously across regions rather than in isolation. This combination suggests that the system is not dealing with a single shock event, but rather a prolonged adjustment in global silver distribution. Whether this evolves into a sharp repricing or a sustained high-tension equilibrium depends on how quickly supply responses and demand adjustments can restore balance. Ultimately, the key issue is not short-term price direction, but the integrity of the connection between paper claims and physical availability. As long as that connection remains stable, the market can absorb significant stress without breaking. If it weakens further, price will increasingly reflect physical constraints directly rather than financial positioning alone. The next phase will be defined by whether current pressures begin to ease through normalization or whether they continue to build toward a point where physical markets begin to dominate price discovery in a more visible and accelerated way across the entire global silver system.